Donald Trump's statement of not tolerating injustices on trade. Is this going to keep emerging markets jittery? Will you buy emerging market equities?
All right, good morning, and thank you for inviting me on your show again. So just dealing with that particular issue, I think going into the midterm elections, I should imagine that we should see that trade rhetoric remaining hawkish until, if possible, some form of trade deal or bilateral trade deal or some form of concessions are achieved between China and the United States that Trump can then go to the Republican base to help in the midterm elections. So I think that will be the remaining focus. That's pro-dollar. That's negative for emerging markets. That in the context of the Asia-Pacific region is probably pro-Indian equities, less correlated with the global trade cycle. But generally speaking, it should be a headwind against EM until some form of deal is done.
Okay, so the focus of the Fed will be pro-dollar, and that could be negative on emerging markets. Paul, hi, good morning. But we've already seen the MSCI Emerging Market Index fall 8% in 2018 so far. India has been far worse. In fact, it's almost a 10% cut. What kind of downsides do you see for the rest of the year?
Right, so it really depends on whether a trade deal is done between China and the United States before or after the midterm elections. So I think when we look at the benchmark that I've looked in and have done some quite considerable analysis on is looking at the Morgan Stanley Asia ex-Japan index. And if we look at the MSCI Asia ex-Japan, yes, it's below its 10-year average, but it's not even one standard deviation below that. And it's certainly somewhat above the post-GFC low, which from end August numbers is about 15%. Now, that 15%, is a scenario which I think becomes possible if there's no resolution on trade, nothing that actually leads to any form of ceasefire or detente between now and November. Because I think the way to look at this is that the current characterization in the markets themselves, I think, are pricing in some form of deal getting done within sort of that tight framework. If it's not done by November, then instead of this being an event trade, it's an open-ended proposition. And that's more serious as far as the economic implications for trade wars.
Okay. Paul, good morning. So if the markets do get bad news, in that case, how much downside do you see for a market like India, for example, which is a high beta market and which has other headwinds to negotiate with, for example, the higher crude oil prices?
Right. So India has been, is my biggest weight, biggest overweight in Asia Pacific. So just to put it into a little bit of context. So in Asia Pacific, we've been overweight Japan all year, underweight Asia ex-Japan, and within Asia ex-Japan, overweight India and overweight the consumer. Now, the main reason for being overweight India and overweight the consumer is that because the growth profile in both of those areas are not as correlated with global trade and hence less vulnerable to a trade shock. Now, as far as India is concerned, we've got very solid earnings growth. So we're looking at 14-15% earnings growth this year. Yes, valuations are at a premium to EM, but that's okay. That premium is deserved because of its less correlation with the trade cycle. Now, as far as higher oil prices, particularly in rupee terms, are concerned, this is not translating into inflation. So we saw the most recent inflation data being actually slightly less than 4%. Now, there are two reasons, I think, why we're not seeing sort of weak rupee translating and stronger oil prices in rupee terms translating into inflation, which would make the RBI more concerned, are twofold. One is that we've got the reverse repo rate already at a 200 basis point positive real yield, which is keeping demand under control. And the second point is agricultural prices are actually quite soft. So those two factors there are offsetting oil and the weak rupee, which is actually quite positive for Indian equities.
Oh, yes, take your point. A lot of people are not expecting that the one-year forward inflation trajectory is going to rise too much despite the combo of crude and the rupee. But just to come back to the Fed meeting, which is underway, and we'll get the result tomorrow. U.S. yields trading at 3.1 now. Where do you see it, say, 3-6 months down the line? 3 months first. And if that goes to 3.25, are we going to get other kinds of headwinds of too strong a dollar or in any other form outflows from EM?
Okay, that's a great question. So for me, when we look at this year, the damage that's been done to EM has been largely been driven by currency, a broadly based strong US dollar. So it's not been isolated too much, in particular EM, outside of Argentina, Turkey, and Brazil. So in the context of the Asia-Pacific region, it's been a sort of a stronger US dollar. Now, the stronger US dollar, in my opinion, it's not driven so much by long yields. It's been driven by trade hawkishness. Now, trade hawkishness over the short term for a deficit country such as the United States is pro-dollar because it's a positive trade flow factor for the U.S. trade account. And so when and if we see a reverse of this, I would think we would actually sort of, if we get some form of detente on trade, then we'll see, a flattening out or possibly a weakness in the dollar. Okay. So I'm not worried about bond yields hitting, so to answer your first question, 3.25, 3.5%.
Okay.
That's not really a concern.